I think the Greek election results actually is probably a much bigger story than people are realizing. Some people are saying it's not really a problem, it's all going to get swept under the carpet. And I think there's a really big misunderstanding about what's happening here. So everybody is focused on the debt, which I guess is understandable. Greece has 175% government debt to GDP, which is the biggest in the Eurozone. And obviously one of the things that the Syriza party have been saying is that they want to renegotiate the debt. And so, we're going to see a situation, I think, where they're going to be talking to the other Eurozone government leaders, because they've said they're not going to talk to the Troika, they're not going to talk to ECB. And so that actually is a very tense, potentially very tense situation. Now, having said that, we've seen other governments in the past. So a couple of years ago, there was an election in Ireland, and there was an anti-austerity government elected in Ireland. And when those guys got into negotiations, they basically just gave in. They did some small renegotiation, but I think everybody was very disappointed with them. And I think a lot of people are expecting that maybe that's what's going to happen again this time. So the new Greek Prime Minister, Alexis Tsipras, will just go and have some negotiations. Maybe he'll get some small concessions about the term and the interest rate and things like that. And maybe he'll go back to the Greek people and say, actually, I couldn't get a very good deal. This is the best I could do. Now, if that happens, I think the markets will quite like that. But that will probably be just about the worst possible outcome for the Greek people, because what it means that Greece is going to be staying inside the euro. And although everybody talks about the debt isn't really the problem here. The big problem is the fact that Greece is in the wrong currency. This is the problem. Remaining in the EU is a different story, because you can be in the EU and not actually be in the euro. If you look, there's quite a few member countries of the EU that don't use the euro, like the UK, for instance. But the real problem that Greece has is that it's in the wrong currency. The best comparison I can make maybe is in Thailand in the mid-1990s. We had this currency pegged to the US dollar. And that became a real problem for Thai competitiveness. And the only way that the only way we could get around that was by running a current account deficit that was financed from overseas. And eventually the interest rates increased and the current account deficit became unsustainable. And then at that point, we had the baht depegged. And although that was very dramatic, I mean, I was here in '97. I remember that. It was quite a scary time. Actually, that created quite a prosperous period for Thailand after that, from 98, certainly until the global financial crisis. Thailand was growing reasonably healthy. It was very competitive because it had a competitive currency, and it was able to run a current account surplus. Now, this is exactly what Greece needs to do. The problem is that Greece is part of this currency that's essentially it's a currency peg. Greece is pegged to the euro when the euro doesn't fit Greece. And it's not actually the debt issue that's the biggest problem in Greece at the moment. It's the fact that ECB rules are telling Greece has to run a primary surplus. And so to do that with an uncompetitive currency, the only thing it can keep doing is this crazy austerity, which is pretty much bankrupting the entire Greek country. So the best thing that can happen for Greece is to leave the euro. This could happen if we have some problems with the debt negotiations, and if everybody falls out badly and they're not able to agree something, or it could happen in a more orderly way. But either way, it's the best thing for Greece. The problem is it's disastrous for the eurozone. I think everybody's looking at the so-called gypsy countries, Greece, Ireland, Portugal, Spain, Italy, and they're saying, well, that's where the weakness is. Actually, that's not true. The big weakness in the eurozone is actually in Germany, because that's where all the debts ultimately end up. Exactly. And so, Germany's benefited from this weak currency, from the currency union. It's really benefited from that quite strongly. If we start to see one country, like Greece, leave the euro and do very well because of that, it'll be pretty quick that we'll see Portugal, Spain, Italy, we'll see pretty well everybody not want to be in the euro. Germany will be there. It'll be the last country left as part of the euro. And really that could be absolutely catastrophic in the short term for the global economy and certainly for the eurozone. I think it would be a very similar story for Greece. Yeah, I think in the same way that in Thailand, yes, we obviously we had the banking sector problems in '97. We had we'll get those same issues in Greece. But if you remember, Thailand did recover fairly quickly from that. In 1998, Thai baht was the strongest currency in the world. It strengthened more than any other currency.
asset.
Exactly. So we saw this. We saw this, huge competitiveness for Thai exporters that really started in 1998. We saw current account surplus. Greece will get all of those benefits if it leaves the euro. It really needs to go back to the drachma, and it needs to figure a way to do that. And, like I say, it could be something that everybody works out a very orderly deal, which would be okay. Or it could be a totally disorderly deal where, nobody can agree anything. It almost happens by accident. And in that case, global markets are we're going to see a lot of bank failures in Europe, where it's going to spread to the States. We're really going to see a very, very dramatic depression globally for a short period of time. And as I say, the Greece, Ireland, Portugal, Spain, Italy, those countries will recover quickly like Thailand did in 98. Germany, on the other hand, is facing maybe a Japan-style depression for the next 20 years if that happens.